Hello, I'm Rachel Jones for the Finance News Network. Joining me today from the CML Group is CEO Daniel Riley. Daniel, welcome to the network.
Thank you.
Just to start off, can you give us an introduction to CML?
Absolutely. So CML Group is a business lender providing a specialised form of finance that provides working capital for businesses in exchange for their invoices. CML Group has a market cap of just under $100 million. We have a very supportive institutional group on our share register with 50% owned by around 15 institutions. The board and management own around 13% of the company, all aligned interest in ensuring that the company continues to build earnings.
And now to your services, can you tell us a little bit more about Invoice finance?
The common problem facing businesses is cash constraint, which is caused by delayed payment from their customers. In addition to that, and adding to the problem, is that businesses are often reluctant to chase payment from their clients, concerned that it might affect their relationship. So Invoice Finance solves that problem by purchasing the invoices from businesses upon completion of the service, providing an immediate injection of cash, which the business can use to meet whatever their business obligations are, being payroll, servicing the next client, ATO obligations, or anything else. In addition to that, we hope to solve the problem by providing a receivables management function, where we actually manage the calls to the client's client, and in doing so allow our clients to maintain their relationships and continue to focus on their business growth.
And what can you tell us about equipment finance?
Equipment finance is a broad industry. We've found a niche which is focused on second-hand equipment, things that have a very good resale market, transport, yellow goods, items like that. There is work involved in second-hand, including valuations, understanding the ownership structure. We take the asset as security, usually additional equipment, and in 50% of our lends we also take property security, so we're very comfortable with the business model.
And now to finances, can you give us an update on how 2018 is shaping up?
2018, the first half compared to the same period last year, we've seen a substantial uplift at all levels. Firstly, at the volume of invoices purchased, that's increased by 16% to 581 million compared to 501 for the same period last year. We've actually had some margin improvement in this most recent half compared to the same period last year as well. So our revenue growth on those invoices purchased has actually exceeded the growth in invoices purchased, so up 31% compared to 16% at the volume level. That increase in revenue has flowed down to EBITDA, also a 31% increase, and a further improvement at NPAT-A level of 86%, which has allowed us to increase the dividend by 50% from half a cent to 0.75 cents for the half.
And now to a more general question. Mobile apps have made inroads into many aspects of our lives. How have they affected your markets?
What we feel that we do very well is manage customers. There are many fintechs with mobile apps who aren't as good at managing business, but they are very good at customer acquisition. So where mobile apps have affected us is in that customer acquisition phase. We're competing against the fintechs by creating a fintech skin on our business, effectively technology to allow online application, access to a client's cloud-based accounting data, and once they're on board as a client, a mobile app that allows our clients on the go to see their funding availability and request a drawdown. And we feel that's been under development for 18 months. We feel that we're very close to being competitive in that space on the client acquisition side.
And now to the last question. What can investors look out for in terms of news flow over the next 6 months?
A couple of key things. We've just completed an acquisition of Thorn Trade and Debtor Finance, which is our fourth in this space. That will increase our total invoice volume in 19 to 1.5 billion. Compared to 1 billion in FY17 and around 1.2 billion in FY18. So I think in terms of news flow, first of all would be successful integration of that acquisition. Secondly, we are undertaking a transition in our funding from more expensive historic funding arrangements with bonds to a securitisation facility with a big bank. We expect that to complete during early April. And that transition will save $3 million in interest costs on like-for-like volume FY19 compared to 18. So those are probably the two key components of news flow to watch out for.
Excellent. Daniel Riley, thanks very much.
Thank you.